Trading is exhilarating but also a perilous form of speculation that can undermine your finances. Get ready for an emotional journey that will make you question if risking your wealth for quick gains is worth it. Furthermore, we will teach you an investment approach that can provide you with higher, stable returns and lower risk. Let's begin by explaining what trading and speculation are. Speculation and short-term trading are related in their focus on profiting from price fluctuations within a relatively short period. Both involve a shorter time horizon compared to long-term investing, which means investors adopting these approaches seek quick profits rather than holding assets for long-term passive income. Moreover, both speculators and short-term traders often employ technical analysis as part of their methodology. This involves studying charts, technical indicators, and price patterns to identify buying and selling opportunities in the short term. Decision-making in both cases is based on signals that can change rapidly, requiring the ability to make quick decisions. Meet Carl, an individual who has fallen into the trap of irrational speculation. From a young age, he always harbored the dream of getting rich quickly. Obsessed with the idea of amassing a fortune in a short time, he ventured into the world of short-term trading. His objective is clear: make money quickly and easily. Carl has no interest in in-depth analysis or researching companies or assets. His sole focus is the current price and short-term market trends. He believes he can predict the next big move and capitalize on it for significant gains. Instead of developing a coherent strategy, he relies on rumors, friends' advice, and daily news. If he sees a stock that has recently surged, he feels tempted to join the buying frenzy without considering the long-term consequences. Although Carl has had moments of success in the short term, his irrational approach has led him to face significant losses, and his lack of a solid strategy has left him trapped in a constant struggle to recover what he has lost. Predicting the short-term economy and short-term stock prices is a task often met with significant challenges due to the prevailing irrationality in financial markets. This irrationality largely stems from human nature, which is inherently unpredictable in behavior. Investors in financial markets can be influenced by emotions such as fear, greed, and euphoria, often leading to irrational decisions that cause stock prices to move illogically and erratically. Herd behavior is another factor contributing to market irrationality. Investors often follow the herd, buying or selling stocks based on what other investors are doing, rather than conducting fundamental analysis. This herd behavior can lead to speculative bubbles and sharp drops in stock prices. Benjamin Graham, considered the father of value investing, defines investment as follows. Investment is an operation that, upon thorough analysis and rational judgment, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. Let's meet Travis, an exemplary investor who is guided by rationality and logic in the world of finance. From an early age, Travis had been an avid reader and student of financial markets, but his approach was always different from the majority. His goal is clear. He aims to build a solid and secure investment portfolio that provides steady growth over time. Travis is not interested in quick gains or the game of guessing market movements. He understands that long-term investment is the key to achieving his financial goals. Over the years, Travis has developed a deep understanding of the companies and assets in which he invests. His strategy is based on identifying companies with strong fundamentals, sustainable competitive advantages, and effective management. Instead of following market trends, he conducts thorough and detailed analysis before making an investment decision. Travis's key is his patience. He knows that markets can be volatile and that stock prices can fluctuate in the short term due to emotional factors and daily news. But, instead of being swayed by these fluctuations, he remains calm and sticks to his long-term strategy. His buy and hold approach allows him to capitalize on the power of compound interest and benefit from the steady appreciation of his investments as time passes. Peter Lynch, a well-known fund manager and renowned author, he suggests that over the long term, it is possible to achieve positive returns by investing in strong companies operating in growing industries. Travis was not attracted to the excitement of following market trends or joining the crowd in buying and selling frenzies. Instead, he preferred calm and objectivity. Despite pressure from friends and family to join the latest investment trends, Travis maintained his focus on fundamental analysis and long-term patience. A pivotal moment in Travis's life was when everyone around him was buying assets in a speculative bubble. Greed was in the air, and it seemed like everyone was on a quest for quick profits. However, Travis chose not to join the crowd and, instead, conducted thorough research and discovered that the assets were overvalued and destined for a correction. Over time, Travis built a strong portfolio based on his contrarian approach. He identified opportunities when others were fearful and steered clear of unrestrained greed. Following the contrarian investor approach, it allows you to buy assets at lower prices, as it seeks opportunities when prices are low due to the market's general perception. Over time, as the market recognizes the underlying value, these prices tend to rise, resulting in substantial gains. Additionally, being a contrarian investor avoids falling into speculative bubbles, as it doesn't blindly follow the crowd in buying frenzies. Avoiding inflated assets destined for correction protects capital from significant losses. This strategy also allows you to identify overlooked opportunities. Often, the market overlooks companies or assets with solid fundamentals but going through short-term challenges. Contrarian investors can benefit when the market finally recognizes their value. Finally, contrarian investors compete with fewer investors, meaning less competition for the same investment opportunities. This allows them to find undervalued assets before the crowd catches on.